What's up everybody, I'm Jaspreet Singh, and by now you've probably seen it all over the internet and YouTube. People making videos after video talking about why they're selling their stocks and why they're dumping their investment portfolio because of fears of a looming recession. The whole idea here is the skyrocketing inflation is leading to a slowdown in spending, which might lead to a slowdown in the economy. Couple that with the geopolitical tensions that we're seeing between Russia and Ukraine, which might lead to significantly higher oil prices, meaning a higher cost of doing anything. And this has investors on the internet and off the internet worried about a potential recession, which means a slowdown in the economy, which means a slowdown for companies, which means a slowdown in the stock market. So you have some investors that are selling off their portfolios, hoping that they'll be able to buy the dip if and when stock prices go down. So what I want to do today is talk about how you should be investing your money right now, particularly with a recession on the horizon. And that means I want to go over three things. First, I want to go over timing the market. Then I want to go over the difference and the correlation between a recession and a stock market crash. And third, I want to go over what you can do with your money to come out of this a financial winner. Now, as always, if you do want to stay up to date on what's happening in the financial world, you can subscribe to Market Briefs. It's a free financial newsletter that I created that breaks down what's happening in the finance and business world in 5 minutes or less every single morning, and you can read it while in your briefs. I'll put it for you in the description below. First, let me talk about timing the market, because we all know by now that the stock market has booms and busts. In reality, what the stock market actually does is we see the stock market not move linearly like this. We see a boom and bust and boom and bust and boom and bust, where you have this line kind of moving upward, but you still have these boom and busts happen in the stock market. So if the goal in the stock market is to buy low and sell high, wouldn't it just make sense to wait until a stock market crash and then buy and then ride it up? Well, in theory, yeah. If you can come in and buy the stock market at the bottom and ride it up and sell it up here, then you will make a big profit. But doing that isn't always so easy. Bank of America did a study where they looked at the stock market between 1930 and now and what would happen if you timed the market. If you did everything right, and every decade you did not have your money invested in the worst 10 days of the market. In the 1930s, you would have had a 39% return. In the 1940s, 136% return, and on and on and on. And over the course of 1930 to the 2020 decade, you would have made over a 3 million % return. That's pretty good. But now let's look at what would happen if you didn't perfectly time the market, because if you were to miss the best 10 days per decade, now you would only get a 28% return if you missed those best days. But if you didn't try to time the market and you just let the stock market do its thing, you would get a pretty hefty 17,700% return. So what that means is over the course of the last 9 decades, if you tried to time the market and you missed all of these days, the worst 10 days out of every single decade, and you did it perfectly right, where you only missed those down days, you would get something like a 3.7 million % return on your money, which is a pretty crazy return on your money. However, if your timing wasn't perfect and you missed some of the biggest days per decade, if you missed the 10 biggest days per decade, and typically some of the biggest up days happen right after you see a big down day, because now the stock market has a lot of momentum and people are trying to buy the dip, rallying it up. If you miss the biggest 10 days per decade, then your return drops all the way down to 28% over the last 9 decades. And then if you didn't try to time the market, you just bought in and let the market do its thing, well then you saw a 17,000% return without having to deal with any of the stress. So what this data is telling us is if you have a crystal ball and you can perfectly time the market, it will pay off. But if you cannot perfectly time the market, then you can lose out on some massive returns. But if you don't try to play the game and you just put your money in the market and you give it time to grow and you let the market do its thing, you can still come up with some pretty solid returns. Now I know 17,000% is not 3 million %, but 17,000% is a whole lot better than 28%. The reason why so many people end up sucking at trying to time the market is because of something called the hot hand fallacy. So let's say you're trying to ride up the market, and then the stock market starts to go higher and higher and higher, and you have some winning stocks. Well, what happens is you keep telling yourself that the stock is going to go even higher because you've been right until now. You've made 100% returns and you tell yourself that you will sell as soon as you see 125% returns. And you're waiting and waiting and waiting, and then the stock starts to go down a little bit. Your 100% return goes down to 90%, but it's just a little bit of a dip. You're just going to wait for it to turn back around, and then it goes lower and lower and lower, and now your profits are wiped out. You made 100% returns, you were trying to time the market, and you were just waiting for it to go a little bit higher, but you got greedy, and now it's going down. And now you missed the opportunity to sell at the peak. And it's the same thing on the way down. Because what happens is you start to see the stock market go down and you say, this is a great opportunity for me to come in and buy at a discounted price. I'm just going to wait for it to go down a little bit more. The stock that you want to buy goes down by 30%, but you want to buy it when it goes down by 40%. So then you wait, it goes down to 33%, 35%, 37%, just a little bit more. And then you're going to come in and buy. But then it starts to go up. It goes up 7%. And you say, oh, this is a dead cat bounce. It's going to come back down. And you're just waiting for it to come back down to that 40% so you can pull the trigger and buy. But then it keeps going up. And now you say, oh man, it's too expensive. I don't want to come in and buy at this price. And then it rallies another 40%, and then you missed out on all of that upside because you were trying to time the bottom. Nobody knows when the bottom will be. Nobody knows when the top will be. That's why instead of trying to time the market, the simplest way to actually make money in the market without all that stress is just by investing your money over the long term. The second thing that you have to understand is the difference between a recession and a stock market crash, because if you just look at the economic environment that we're in right now, where we have rising inflation and an economy that's already starting to slow down because spending is already slowing down, it looks like we're going to enter a recession. And so if you are very certain that we're going to enter a recession, doesn't it just make sense to sell right now or wait to buy until we see a recession, because then you could just come in and buy stocks at a discounted price? Well, not always. See, the economy and the stock market are linked, but they're not always linearly correlated. There will be times where the economy is going up, but the stock market is going down. And there's also times where the economy is going down and the stock market is going up. We saw this happen in 2020 because when the economy shut down, the stock market collapsed, and then the economy continued to suffer, but the stock market started to rally. When the 2008 recession hit, we saw a massive stock market crash, and then in 2009, the stock market started to rally, even though the job market didn't come back until 2015, but the stock market had already rallied for a number of years. This creates a very interesting chicken and the egg dilemma. All your Bob Ross comments have been getting to me, so I'm trying to work on my drawing skills. I know I'm not the best at it, but this creates a chicken and the egg dilemma where you have to understand what comes first. Does a recession create a stock market crash, or does a stock market crash create a recession? Now, at first glance, you might say, Jaspreet, what the heck are you talking about? How in the world can a stock market crash lead to a recession? Well, you have a lot of companies out there that rely on their stock price to continue funding their operations. If they don't have a high stock price, they can't hire people, and if the stock price goes down, they have to lay off their employees. Right now, there are dozens of companies with billion-dollar valuations that are not profitable on the stock market, and the reason why they're able to run their company even though they're not profitable is because they rely on their stock price to raise money, raise debt, or raise investment capital. So because they have a high valuation, they have a high stock price, they can go to a bank, they can go to an investor, and they can raise money. Because they're able to raise this money based off of their high stock price, their high valuation, they can take this money and invest it into their company and hire employees. But if the stock price were to fall by, say, 40%, well, then they're not going to be able to go out and raise investment money, because nobody's going to want to invest money into a company that has a small valuation or a company that's losing their market capitalization. And so if they're not able to raise money, then they're going to have to shrink their operations, which means that they're going to have to fire people, and that can lead to a number of people losing their jobs. That's one of the reasons why the Federal Reserve Bank worked so hard to prop up the stock market after the 2020 pandemic, because they were worried that if stock prices fell, this would cause a trickle-down effect where more and more companies would be forced to lay off employees, which could lead into a bigger recession, because if companies don't have this higher market capitalization, they can't raise money, they can't get capital, which means they won't have money to invest back into their companies and hire more employees. So if stock prices fall, this can force companies to fire people, which means you have a higher unemployment rate just because the valuations went down. So stock prices falling leading to a recession would be a case of the egg coming before the chicken. But the more apparent one is the chicken coming before the egg in the case of a recession causing a stock market crash. We've seen this happen a number of times throughout history. We just saw it happen in 2020 when the economy shut down. It led to a stock market collapse in 2008. When the whole meltdown was happening across the financial industry, the stock market collapsed. So in that case, the chicken came before the egg. But the thing that's interesting about recessions and stock market crashes is that it's different than a chicken and the egg, because sometimes you can have a recession without a major stock market crash. So in this terms, that means you have a chicken without an egg. I want to thank Andre Gik for finding the study by Russell Investments, but between 1869 and 2018, we had 30 economic recessions. But out of those 30 economic recessions, 16 of them had a positive stock market growth. That means if you looked at the stock market from the beginning of the recession to the end of the recession where the economy fell, 16 out of 30 of those times you had a stock market that grew during the period of the recession. This is why it's very important to quantify things that you talk about. If we're talking about a stock market crash, in general, that means you are entering a bear market. A bear market means that the stock market has fallen by 20% or more off of its highs. A recession, on the other hand, is when you see 2 quarters or 6 months of GDP decline. That means you have 6 months of an economy slowing down. So this is 6 months of slowdown in the economy. This doesn't mean that the stock market only goes down half the time that you see a recession. It means that the stock market doesn't always correlate with the economy. Sometimes the stock market is late to react, sometimes it's early to react, and sometimes it might not react at all. For example, between the years 1947 and now, we had 12 economic recessions, but at the same time during these years, we only had 11 bear markets. Let me translate what this means to English. Most of the time that we see a recession, it is going to cause some sort of bear market, meaning a stock market crash of more than 20%. But over the course of the recession, most of the time you are going to see the stock market recover and even grow during the period of the recession, which is why you can't time the stock market based off of the economy, because sometimes you're going to have a recession that doesn't equal a stock market crash. Like if we look at the S&P 500 from 1984 until now, you'll see that the stock market has gone through booms and busts and booms and busts and booms and busts, but overall it's a lot higher now than it was before, even if you bought right before a bust. So based on the data, for the average person, the best thing for you to do is not try to time the market, it's not try to figure out the best time to buy, it's not try to sell at the perfect time before we hit a recession, it's just to buy stocks and hold on to them for the long term. Now, one of the easiest ways that you can do that is create a dollar cost average system where every time you get paid, a little bit of your money goes into a few ETFs that give you exposure to the general stock market. That way you're not trying to individually find the best company, because if you don't know how to research companies, if you don't know how to keep up with companies, and if you don't know how to find companies, then you might be investing your money into a risky company just because everybody else is trying to hype this company up, and then you can see a whole lot more volatility there. I like to use a platform called M1 Finance. They are a sponsor of Minority Mindset, but it's a super easy way for you to automate this passive investing strategy. That way you can just pick whichever ETFs that you want and create a system where every week or every 2 weeks or every month, some of your money automatically gets invested into these ETFs, and you don't even have to worry about it, and it happens without you having to do anything. So if you want to learn more and see how you can start investing with them, I'll put the link to how you can do that down in the description. But what happens if I'm wrong? I mean, the data up until now has showed us that the stock market has gone up over the last 30 years, and we've seen the stock market continue to go up over the last 100 years, but what happens if this time is different? We've seen it happen in Japan, where the Japanese stock market went 30 years without seeing any growth. If you look at this chart right over here, if you invested into the Japanese stock market in 1990, you would have steadily seen a decline and then a sideways market for 3 decades before you even came close to a profit. It is possible. Now, the advantage that the United States has is the American economy is the strongest economy in the world. So if I was going to bet on any economy in the world, I'd want to bet on the American economy. And the way that you can do that is through the American stock market. So we have that advantage. But then if you really want to protect yourself, that's where you can look at having some real diversification in your investment portfolio. That way you can protect yourself from anything that could potentially happen. Personally, what I do is I invest some of my money into ETFs that give me exposure to the S&P 500. That way, if the American economy grows, the stock market will grow with it. But as some real diversification, I also have some ETFs that gives me exposure to emerging markets. These emerging markets are companies that are outside the United States. So if we were to see this sort of sideways stock market for a long period of time and other countries outside of the stock market were to grow, those emerging ETFs, those emerging market ETFs would give me exposure to that. So it's a type of real diversification there. And I also have money outside of the stock market where I also invest in things like physical real estate. I also have some cryptocurrency. I also own physical gold. I also have my own business, and I also invest in startups. So you can look at having some real diversification. Now, I know if you're just starting off, it's going to be very hard for you to invest in real estate, the stock market, different ETFs, invest in startups, create your own business. But you have to start with one place, and as you start to do that, that's where you can grow. I mean, when I first started investing, I only had a few $1,000s, and everybody has to start from somewhere. But as you start, you want to keep learning, you want to keep growing, and you want to keep reinvesting more money. That way you can build a snowball that continues to compound. And I want to hammer this home one more time, because a lot of times we create the smoke screen for ourselves where we say that's impossible for me because of where I grew up, because of who my parents are, because of how I was raised. But the reality is, it doesn't matter where you come from or what type of job you have or what degree you had. Anybody has the opportunity to succeed if you're willing to learn and if you're willing to work. My parents came to this country with next to nothing. My dad had less than $100, didn't even speak English when he came to this country, and I didn't grow up with any sort of financial education. I wasn't told to invest my money. I didn't know what investing was. I didn't know what real estate investing was. All of these things were completely foreign languages to me because I was told that I needed to become a doctor. But for me, this was really interesting. I saw how hard my parents worked, and I wanted to take care of them. So I went on my own quest to become financially educated. I started by reading books. I started by investing my own money. I started by trying different things. I started my own businesses. Some of them made me money, some of them lost money, but you have to be willing to try, you have to be willing to learn, and you have to be willing to put in the work, and it's a process. It's not something that happens overnight. This is something that takes years, and it'll take you really about a decade to figure things out and really start to see the success that you put in over that decade. I know everybody wants to see the overnight success, but it takes time, and you have to be willing to learn. And if you really want to make money, you have to understand that the real money is made over the long term. It's not made overnight. If you want to continue building your financial education, here's a video on some of the biggest risks for your money that I think you will love. And while you're at it, I have a free guide that you can download on how to start generating passive income, and you can download it by clicking that button below. If you are not going to the restaurant and buying the extra guac, well then the restaurant's not going to have any money to pay their employees, let alone have any money to open up a second store.